Hey everyone, Richard here, and in this video I'm going to talk to you about the difference between an asset and a liability. I'm going to share the concepts that I have learned from reading the book Rich Dad Poor Dad by Robert Kiyosaki. I'm going to share with you how I took those concepts and those strategies, applied them in my own life, and how my clients have applied those strategies too to build long-term wealth and build multi-million pound property portfolios and start to accumulate and create wealth. Now, if you've read the book Rich Dad Poor Dad by Robert Kiyosaki, then you may be familiar with some of the concepts that I'm sharing with you here. And if you haven't read his book, and this is the first time that you're seeing this, then this is going to be super valuable for you. However, even if you've read the book Rich Dad Poor Dad by Robert Kiyosaki, this is still going to be super valuable for you too, because I think, I don't know about you, but when I read a book, I don't always apply the theory. And what I've learned is that theory and reality aren't the same thing. So we can know something by reading a book, but unless we really understand it at the granular level and apply that theory into reality and learn from experience, we never really make any changes or differences to our lives, because we have to take the theory and apply it and then go through proprietary feedback loops to get the feedback and then iterate to scale our lives. So not only am I going to show you the concepts in this video and how we can apply this to our own personal balance sheets to create wealth, I'm going to share with you the difference between someone's balance sheet who's working every day in corporate, and that was me before I started building a multi-million pound property portfolio. I'm going to show you what my balance sheet looked like, and I think a lot of people may resonate with that as well. And then I'm going to share with you what my balance sheet looks like now, and typically how that's helped me to grow and accumulate wealth in my own life, and how that might help you too. But I'm also going to show you how to take this information and apply it into a real life worked example, which I'm going to show you at the end of this video. If you stick around until the end, I'll go through a real life worked example with you, and we'll put all of the theory into reality and start to take action on these concepts and things. So for those of you who don't know me though, my name's Richard Norris. I've successfully built a multi-million pound property portfolio, and I've helped over 300 clients to do the same. So let's jump in. What is an asset then? So an asset is something that pays you every month. That's a definition of an asset. And the true definition of a liability is something that costs you money every month, like expenditure. So now, the biggest mistake that I see most people make when I speak to people, especially when I'm doing consultations to people that want to enroll in our program and we're looking at their current situation, the biggest mistake that they make is that they think that their asset, the biggest asset, that they have in their life is their own home. And that couldn't really be further from the truth, because normally most people have a mortgage on their own home, right? And they pay their mortgage off every month. Now, typically that's a liability, because your mortgage is your biggest monthly expenditure each month, right? So we typically go to work, and then we go to work to basically earn a living to live in the house that we want to live in, right? And we kind of go around on this perpetual cycle of going to work, paying down our mortgage, going to work, paying down our mortgage, and other costs that we have, which are liabilities, which I'm going to share with you in a second. And we kind of get stuck on the hamster wheel and the treadmill of the monotony of going to work, paying down the mortgage, and we kind of feel like there's no other way. And ultimately, it's just because the way we're using our balance sheet that's causing us to stay in a job that maybe doesn't necessarily fulfill us and prevents us from working on our passion. And that's purely because we're thinking that our own home is an asset, and it's not. It's a liability, because like I say, it's the biggest monthly expenditure you have, which is your mortgage. So let's look at let's start to jot down on here some assets and some liabilities. And I'll show you in the first example here what a typical balance sheet looks like. Now, Robert Kiyosaki describes this in his book as Poor Dad. And then the second balance sheet I'll show you is Rich Dad, which is how most people, if you've grown a multi-million pound property portfolio, how your balance sheet will actually look. So let's take a look at an asset then. So one of the assets that we have on the first balance sheet is we have a job, right? We earn money for a living, and it's our salary. Now, I've looked across Google and the website, and you can obviously find anything on Google, right? So I typed in what is the average earnings for, or average salary for an individual in 2022 across the UK, and lots of things came up. Now, the Office of National Statistics said that the average income was £38,131 across the UK. Personally, I think that's a little bit high, and I looked at other sources, and other sources said anywhere between 25k to 35k. So if we kind of take the median, like around 30 to 31, I think is probably like the most accurate figure of the average salary in the UK right now. So our job is our kind of our biggest asset if we don't have any other investments in our life, right? Then the other thing that we have as assets is we may have some savings. Okay, maybe we've got some stocks and shares, right? And maybe we've got dividends, right? So if you own a company and you're a business owner watching this video, then you may be taking dividends from your company, right? And that, again, that's an asset. And then if you're somebody else watching this video and you're a property investor, or I don't know, you have you do stocks and shares, or you have somebody that, like a wealth manager, that manages your money, then maybe you've got some investments. And this investments can be as broad as property to crypto to other commodities like gold, silver, and maybe you do some trading and stuff. But typically in this balance sheet up here, right? If I go into this balance sheet up here, typically on a normal balance sheet from like 99% of people, their balance sheet will look like this. They won't have any stocks and shares. They won't really have dividends. They won't have any investments. They just kind of have their job and their salary, right? Sorry, their salary and their savings, okay? Now, this is where they get stuck, right? This is where you might get stuck. And this is where I got stuck for sure when I first started out, right? My balance sheet looked like this too. So in terms of liabilities then, what is a liability? So again, expenditure, things that take money out of your pocket every month. So we have things like a mortgage. So we might have a mortgage here, mortgage or rent, right? We may have things like car loans. Okay, so if you're anything like me, I've got a car loan as well that I pay for every month. And then I've got like car insurance, okay? And then we have things like food, right? Food, groceries, all of those sorts of things. And then like gym membership. So I don't know if you're into health and fitness, but I am, and I go to the gym every day. I do all of the infrared saunaing and the cold showers as well as part of my morning routine. But yeah, so if you go to the gym and work out, then you'll have a gym membership that you have to pay a month. You may have a credit card, and you may have some money on a credit card that you pay off every month. You may have things like life insurance, right? So life insurance can go on here as well. And then you may have things like your utilities, your gas, your water, your electric, right? Council tax, basically your general living expenses that you have every month. Then you might have like Wi-Fi costs as well. Then you might have things like fuel and transportation, right? So all of these things that I'm writing down here, they're all liabilities, right? And then like you might have some other things. I'm running out of space here. So you may have things like kids clubs as well, or like school fees or anything like that. Okay, just writing shorthand here. So school fees, you might have your mobile phone that you pay for every month, right? If you're somebody that likes to get your hair and nails done every week, then your hair and nails will also be on here. And if you're somebody like me, ironically, like I have hardly any hair, but I pay like nearly £80 to £100 a month just on haircuts because I get it cut every week and I get my beard done every week. So yeah, if you're someone who likes going to the hairdressers a lot, like me, ironically, then you also have that cost as well. So all of those things are like your general living costs, right? And they're all liabilities. Now, again, from the research that I've done across Google, the average cost, like the average cost of living for an individual person is £2,545 a month. Like that's the average cost across the UK that an individual will spend every single month, right? So typically if we look at like your job and your salary, which is like 25 to 35K, so 30K, 32K-ish, your average like take home will be like 2 to 2.5 a month, right? So you can see here, like across the UK where the problem is, right? You either don't have enough assets coming in to pay for your liabilities, so you're in debt, or your assets just pay for your liabilities and you can't save, and you go around on this kind of perpetual loop. And the way to kind of break that cycle is, if you're in that position and you're watching this video, is to really try and cut out some of these liabilities and reduce them as much as possible, right? So when I first started out and was growing my property portfolio, I looked at all of my liabilities and I started to reduce them massively. I was very frugal. I lived kind of on the minimal that I could, and I saved as much as possible from my corporate job. And then I also done like an equity release from my own home to scale my property portfolio later on. And if you know my story as well, we also use my dad's pension, which I can kind of talk about as we go throughout the video. And I'll show you like an example of equity release and kind of how that works and how you can use your own home, which effectively is a liability, guys, right? Until you do an equity release and use the money from the equity that you get from your own home and invest that to buy more properties and use leverage. If you do that, then you can turn your own home and kind of use the liability and turn it into an asset. And I'll show you how to do that and how the balance sheet looks like if you to do that. But in this position, most people, they kind of have their own home. They either rent or have their own home, and their own home has a mortgage on it. They go to work every day, they get salaried income, and that pays for their liabilities. And they just end up, in this cycle here, right? Where their job is the only income that they have, the salary is the only income they have, and they basically use that salary to pay for all of their liabilities. Now, there's a much better thing to do, and on this example here, right, this is the balance sheet of like what Robert Kiyosaki calls Poor Dad. So this is Poor Dad up here, and this is how Poor Dad is operating his balance sheet. And then we have like Rich Dad here, right? And this is how Rich Dad operates his balance sheet. And basically, just for this example, like rather than writing out all the liabilities again, what we do in this example and what Rich Dad does is Rich Dad use property and dividends effectively from his business and property, and also from his property portfolio, like he gets dividends, right? And then he withdraws dividends from his property portfolio and he uses that to pay for his liabilities, right? And the minimum that they want to get to is that your investments, so if it's 2.5K is the average expenditure a month, that you earn at least £2,500 a month that kind of pays for your general living of 2.5K a month as well. And at this point, this is what everybody terms financial independence, right? This is where you technically become financially free. They say when your assets are paying for your liabilities. Now, at this point, that's just break even. So I would argue that you're not really financially free here, right? You can't do all the things you want to do and you don't have all the choices that you want because you're still in a position where you're only just paying for your liabilities, right? And you don't have any other disposable income, right? So what we want to do in an ideal situation is we want to get our property and our dividends from our business if we're a business owner, or if we own properties and we're building a multi-million-pound property portfolio, then we want to get the income from our properties to pay for our liabilities and give us expenditure on top. Now, most people that I speak to on consultations, they want to really get anywhere between 5K to 10K, right? Now, arguably what me and my company do, we look at getting people to 10K a month of passive income in the most timely way possible, but also in the most safe way possible as well, based on their personal situation, their own financial balance sheet, their own financial income, and their individual circumstances and the goals that they have. Okay, so, and I think like at 10,000 a month, typically you can do most things that you want to do, right? Obviously, if you've got aspirations way above that, then that's great. Maybe you're like me, but 10K a month, if we can get you to 10K a month of passive income from your property portfolio, then typically you could do most things you want and most things you want, in life. And I would call that moment really financial independence when you can make the choices that you want to do and you don't have to think about money anymore, right? So this is what this looks like. So we really want to create this balance sheet here where our assets are paying for our liabilities, and we don't really want this balance sheet up here where we're on the treadmill, going to work every day and using our salaried income to pay for all of our liabilities, because that's what really keeps us on this perpetual cycle. Now, if you're somebody who owns their own home, then like I said, your own home is not an asset, it's a liability, because your mortgage is your biggest monthly expenditure, right? If we go up to here and I say on this liability column, what is your biggest monthly expenditure? It's going to come out as your mortgage and your rent payments, right? So that's why your own home is never an asset, right? Because it's always taking money out of your pocket. It's not really making you money. Now, some people will argue that your own home is making you money because of capital growth. But the real, and I agree with that, that could be the case, but the real definition of a liability is something that takes money out of your pocket every single month, like it costs you money. And your own home every single month, even if you don't have a mortgage on it, you're still paying council tax, gas, water, electricity, TV license, Wi-Fi. You're paying all your living and household expenses, and therefore it's still a liability because it's taking money out of your pocket, right? a property is only ever an asset if you're renting it out and you're making money from the property, right? And then it becomes on this side. It goes over here on the balance sheet, right? So let's go in and talk about like, well, okay, now I understand what an asset and a liability is. That's great. And I understand how I need to get my balance sheet like this. But how do I actually achieve that? Now, specifically in this worked example, I'm going to like really look at people who have their own home. So anybody watching this video, if you have your own home and you've got equity in your own home and you've never thought about this before, then this might be useful for you. And equally, if you've got your own home and you've got equity and you've already thought about this, but you haven't quite had the courage to take that next step, I really want to create a worked example with you below here so you can see how this works and how we can get your assets paying for your liabilities and turn your own home, which is a liability, and we can use that liability and somewhat turn it into not an asset because it will still be a liability, but use the liability to actually create new assets in our lives, which will eventually pay for the liability that we have, right? And I'll explain that now here, right? So let's go into the worked example then. So let's say that you own your own home. So you own your own home here. Okay, this is your own home. You have to forgive me, I'm not the best at drawing, okay? So here's your own home. And in your own home, it may be worth, say, £500,000, right? And for argument's sake, you may have a mortgage on the property of 100k. Just as an example, you could have 200k, 300k of outstanding balance, even 350 of outstanding balance. That's also okay. You could still withdraw equity. You're just going to be able to withdraw less. So in this example, your property is worth 500k. You've got an outstanding mortgage balance of 100k. How do you take the equity out of this property and start to invest that so that actually we turn this liability up here, this mortgage, and we actually turn this liability of our own home into an asset over here, right? So we actually get equity to buy us property over here, and therefore we use our liability to accumulate more assets in our life. How do we do that? So 500k property, 100k of outstanding mortgage balance. Therefore, in this property, we have 400k of equity. Now, what we do is we can tap into that 400k, right? Now, let's say that you earn 100k a year, right? You're somebody watching this video, maybe you earn 100k a year. Doesn't matter if you earn less, you can still apply the formula that I'm going to talk about now. So you take your salary and you times it by 4.5 roughly. And that means that the maximum that you can borrow on this property is 450k, which it just works out that 450k of 500k is 90% loan to value, right? So whenever we take out a mortgage, we talk about loan to value as property investors. And even on your residential mortgage, your mortgage will have a current loan to value, right? Now, the maximum loan to value that you can really have on a residential mortgage is around 90% at the moment. That will depend on your individual circumstances and your own financial balance sheet. But for the purpose of this video, 90% is roughly the maximum that most people can afford to borrow against their own home. So if you earn 100k a year, you take your salary and you times by 4.5 gives you 450 in this example. Again, if you earn less, then you can just take your salary, 50, 60, 70k, 30k even, times it by 4.5, and that will tell you roughly from a high level, before we take off costs, the maximum you can afford to borrow against your property. So in this example, what we could do is we could take out a new mortgage, and the new mortgage we could take out is 450k, right? And that 450k then pays back our original mortgage of 100k. So this is 100k. So take the 450, we pay back 100k, and the difference between these two figures is £350,000, right? So £350,000 of equity we can release, right? And then what we can do is we can take that £350,000 and we can then put that into a limited company, what we call an SPV, a special purchase vehicle, and we can put this money in as what we call a director's loan account. And we can release equity from our property tax-free. The reason we can release equity from our own home tax-free is because there's really two ways. Number one is that, usually speaking, when you buy your own home and you put it on a repayment mortgage, you end up paying down the mortgage using earned income, like from your job or your salary. And earned income is always taxed. So effectively, the money in your property that's been used to pay down your mortgage and build up the equity is already your money that's already been taxed. So they're not going to tax you again, because that would be double taxation, right? And that's the first reason. The second reason is that you're taking out debt and HMRC doesn't see debt as income, and therefore it's not taxable. So in this example where you've got an asset, you've got your own home, which effectively is a liability because it's got 100k mortgage on it. And let's say the 100k mortgage is costing you, I don't know, for this example, I'm just going to say £600 a month, right? Might be costing you more, might be costing you less, but again, just for this example, £600 a month from a 100k mortgage, £600 is what you're paying as a monthly repayment, right? Now, what we can do, so the £600 therefore, would go on this side of the balance sheet, right? It'd sit up here as mortgage or rent. What we can actually do is when we release this equity and take the 350, we can actually set up and put this money into an SPV. And in this SPV, we create a director's loan account. So the money goes in from our own home into the SPV as a director's loan account, right? And then what we can do is we can use that 350k in our SPV to then go and buy some more properties, right? And with 350k, let's say we brought 10 properties, right? Let's say we brought 10 properties. 10 properties. And each of those properties, we put down a 35k deposit, right? Just as an example. So in this example, it might be properties in the Northwest, just as an example, that are valued between 60 and maximum 100k, 120k a month. Value between 60k and say 120k in the Northwest. And it was a 2-bed terrace property or 3-bed terrace. And you bought 10 of those, right? With using the 350k. And let's say all 10 of those properties made you a profit per month of £300, right? So that's your rent minus all your mortgage, minus all your monthly expenditure and costs that you have as a property investor. And the net income from those properties is 300. Now, if we had 10 of those, 300 times 10 would give us a monthly income of £3,000 per month. Now, this £3,000 per month can be drawn out of this company into your own name alongside any other income completely free of taxes, because the money that you put in to start the business, the 350k, was pulled out of your own home as a director's loan account. And what this basically means is that this company, this property company that you've set up, this SPV, owes you £350,000 back before you start to withdraw your income as taxed income. And you would take it as salary and dividend in a limited company in this example. And you can see that the £3,000, if we go back up to here, right? In this example, we'd be financially independent because the £3,000 pays back the 2.5k and we profit an extra £500 a month of disposable income. And that £500 becomes £6,000 a year, and that £6,000 a year compounds and we buy more properties with it. And then the 10 properties may go up in value and we may choose to refinance those again and go again. And we start to gain this compounding effect. Once you start to create that financial pattern in your life, you will reach financial independence. And this is how Rich Dad talks about, Robert Kiyosaki talks about Rich Dad. This is the exact thing he's talking about. And this is like how your assets pay for your liabilities. And this is what I'm doing. It's worked for me. I've put it into practice. It's worked very well. It's worked for a number of my clients. And this is what we help them with as well. So hopefully this video will be useful for you too. And you've learned something from a high level about how you can basically, if you are somebody who's got equity in your own home, how you can basically use that to start your portfolio off, and how you can start to create a better balance sheet so that you've got a Rich Dad balance sheet where your assets are paying for your liabilities, and you don't have this Poor Dad balance sheet over here where your only asset is your job, which is paying for your liabilities, right? You've got to get your money working for you. And ultimately, money sat in your own home is useless because, as Grant Cardone says, I don't know if you follow him, but I'm a big fan of him. I'm a big advocate. I've done a number of his training programs and I've learned tons from him. He'll tell you that you need to get your money working for you, right? You've got to get your money working for you, and that equity in your own home is useless. Money is useless unless it's used right. So this is how we do it. And hopefully that's an insight for you around how your own home is a liability, even though you may think it's an asset, it's not. And hopefully this video explains as to why and helps you understand the difference between an asset and liability, how you can use these principles to apply it in your own life. If you like this video, please give it a like, click the like button. It really helps us to get more people to watch our videos, and that would be very helpful for me. So I really appreciate it if you could just hit the like button. If you liked the video, do that. If you didn't, I love you anyway, and that's also okay. And if you're new to my channel, hit the subscribe button as well, and hit the bell notification. Hit the bell icon so you'll get notifications, right? I always get that part wrong. Hit the bell icon so you get notifications. I upload videos every week, and I upload multiple videos a week, so you can take a look at those. You'll be notified if you click the bell icon. And yeah, go ahead, be resilient, be great. I believe in you. Hopefully you enjoyed this video, and I'll see you in the next one.